It's a strange thing. Some of the most exclusive, most sought-after investment funds in the world, they'll take your money, sure, but only if you agree to let them lock it away. It feels completely backwards, doesn't it? Well, today, we're going to pull back the curtain and dive into some really brilliant research that explains the real reason behind these billion-dollar handcuffs. I mean, really, let's just stop and think about that for a second. You're handing over, let's say, millions of your hard-earned dollars to a fund manager, and you're telling them, yeah, go ahead, lock it up for a few years. Why in the world would you give up the freedom to get your own money back when you want it? It sounds like a crazy risk to take. Okay, so the simple answer, the one you always hear, is this classic trade-off. Investors figure, hey, if I give up my ability to pull my money out, my liquidity, I get access to higher returns. And you know what? The data, for the most part, actually backs that up. But here's the real question. Why? Why does locking up money actually lead to better performance? And the answer, well, it uncovers this deep, kind of hidden conflict between investors and the very managers they're paying. All right, to really get this, we've got to switch seats. We need to see this whole thing from the fund manager's perspective. So let's do a little role playing. Imagine you are a brilliant fund manager. You're smart, you've done your homework, and you've found a truly massive, game-changing, long-term opportunity. But there's a huge problem. This brilliant money-making strategy, it's going to make you look like a total amateur in the short term. And this is where we see the two paths a manager can go down. On one hand, you've got what's called a positive carry strategy. The best way to think about this is like picking up pennies in front of a steamroller. It looks great. You're making small, steady gains every single day, but you're always exposed to that one big, catastrophic crash. Now, the really skilled manager, they often prefer the opposite, a negative carry strategy. This is more like buying insurance. It costs you a little bit of money, consistently, day after day, but you're positioning yourself for an absolutely massive payoff when a certain event finally happens. And this whole idea of negative carry, this is absolutely the key to understanding everything. You are basically choosing to sacrifice those nice, small, predictable returns right now, all for the chance at a much, much larger but less certain gain down the road. It's the smart long-term move, for sure. But here's the rub. It produces a steady, nagging stream of small losses. And that's where all the trouble starts. This right here. This is the manager's absolute nightmare scenario. She knows her strategy is brilliant. She's confident. But all her investors see are those little losses piling up day after day. They have no way of knowing. They can't tell the difference between a genius patiently playing the long game and just a bad manager who's losing their money. So what do? They panic. They pull their capital out, often right before the whole thing is about to pay off in a big way. And this constant fear of investors pulling out, it creates something the researchers call the reputation game. And it's just what it sounds like. To survive, managers feel forced to prioritize looking good now, in the short term, even if it means sacrificing much better returns later on. And look, this isn't just some vague theory. The paper shows it's a completely predictable, even rational response from the manager. This quote from the research really nails it. To avoid getting fired, the manager actually intentionally chooses the worse long-term strategy simply because it looks better right now. And looking good right now is what helps her build a reputation and, well, survive to manage another day. You can see how this creates a really nasty, vicious cycle, right? The manager is scared of withdrawals, so she focuses on short-term results. The investors see that's what she's focused on, so they start judging her only on those short-term results. This, of course, just makes the manager even more scared and more focused on the short term, and the whole thing just spirals downwards, forcing everyone, investors and managers, to focus on a shorter and shorter and shorter time horizon. Now, there's a formal economic term for this kind of breakdown. It's called delegation friction, and it's basically a fundamental misalignment of interests. It's this situation where the manager's fear of being misunderstood literally prevents them from doing their best job. And in the end, that hurts everybody. It hurts the manager's pay, and it definitely hurts the investor's returns. So how do you break out of this cycle? How do you fix this friction? Well, you introduce a commitment device. You introduce the lockup. So a lockup, it turns out, isn't just about letting managers invest in things that are hard to sell, like real estate or private companies. No, its real purpose is to be a direct solution to this trust problem. It's basically the investors telling the manager, look, we trust you. Go ahead and pursue that brilliant but painful negative carry strategy. We can't pull our money out, so you don't have to spend all your time worrying about looking bad for the next few quarters. And you can see the effect so clearly right here. If there's no lockup, a manager is only going to make a small, cautious bet on that great long-term idea. She's just too afraid of scaring off investors. But look what happens. As you add a lockup, and as that lockup period gets longer, her willingness to make that big, profitable long-term bet goes up a lot. The lockup is what directly gives her the freedom to make better investment decisions. But, of course, there's a catch. There's always a catch, right? A lockup is great for protecting a genius from being misunderstood, but it's also great at trapping you with a manager who is just genuinely bad at their job. If the manager is actually unskilled, that lockup prevents you from getting out and cutting your losses. This big risk is called entrenchment, and it's basically the price investors have to pay to solve that trust problem we talked about. Okay, so we get it. This reputation game is real. Lockups are the proposed solution. But what is the actual, tangible, real-world cost of all this signaling and mistrust? How much performance are we actually losing here? So the researchers, they took their model and calibrated it using real-world data from the hedge fund industry. And the result is, honestly, it's stunning. They found that the average new fund manager gives up 146 basis points, that's 1.46% in returns, every single year. For what? Just to signal to investors that they're skilled and to avoid getting fired. That is a massive hidden cost that's baked into the system. Now, this cost doesn't stick around forever. After a manager manages to survive for a year or so and builds up a bit of a track record, that need to constantly signal gets smaller, and the cost drops a lot, down to about 80 basis points. And for those managers who have been around a long time, the ones with a really high reputation, for them, the cost is basically zero. They finally earned enough trust that they don't need to play these short-term games anymore. And this final quote from the paper, man, it just sums the whole thing up perfectly. The entire multi-trillion-dollar hedge fund world, with all its insanely complex contracts and lockups and fees, so much of it is shaped by this one simple, fundamental problem. In the short run, it's almost impossible to tell the difference between a profitable long-term strategy and just plain old lack of skill. Genius and incompetence can look exactly the same. Which leaves us with this really fascinating final question to chew on. A lockup is basically a tool that you use to buy trust, but it comes at a steep price. You give up your freedom, and you take on the risk of being stuck with a bad manager. So when you think about investing, you're not just betting on a manager's strategy, you're also making a decision about what price you, personally, are willing to pay for trust.